Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome back to Real Cash Flow. Today, we're going to dive in with a quick recap of the gold and silver trade and see what's happening with the precious metal complex and the miners. Then we're going to move on to commercial real estate. Commercial real estate has not been hot these last few years. And the question is it time for a turnaround? We'll be discussing the insurance factors and the lack of insurance and the insurance pulling out of many states, creating a negative bottom line for many commercial real estate holders. So without further ado, let's dive into the show.
Hey, Andrew.
Good morning. Good morning.
Good morning.
Right. Yeah, and you look great, Jason, in the morning. I gotta
You like that? Hey, this is protecting the world around me. I'm setting up my office. I think in the next one I'll be able to have a camera on, and then that way I don't have a beach house on the water like you do, Gary, but I'll have something back
next
there.
time you'll see me with dreads. I'll have a dread wig on, and you can tell that I'm in the Bahamas. It looks like Andrew's probably went into the jacuzzi while we were talking, so
yeah, we're coming off as professional. So great job, guys. Great. We start today's episode with a recap of gold and silver and where we're at. Now, the miners have not been able to participate as much as the underlying metal in this rally. Last week, if you haven't tuned into that episode, I want to encourage you to go listen to that full episode. We covered the major breakout in both gold and silver. That's a multi-year breakout that many people have been waiting for, and a ton of money poured into that complex last week. But the big question this week, as we recap and move on to our primary subject, is why have the miners not taken flight yet? And are they a great underlying deal waiting to be snapped up as the underlying asset, the gold, the silver, the bullion itself, continues its march forward? So, Jay, what are your thoughts on that? Why are the miners not catching up?
I've been thinking about it, and I think it's just been a waiting for this quarter's earnings reports that are coming up. So we're just entering earnings seasons. Newmont Mining has earnings coming up this week, and that might be a good tell as one of the big boys on the block on pricing, what gold's costing to bring out of the ground, what they can sell it for, and what their expenses are. So I just think it's more of an opportunity as it's paused because the moves off the lows were confirmed with volume and price action, et cetera, et cetera. So I think we'll probably see some movement one way or the other in the next few weeks. And then you'll look back on this time as like, oh, there might have been an entry there.
No, I'd agree with you. I know May 1st, Barrick Gold reports here. We're at the tail end of April at this point. And you're right. I mean, they're pulling gold out of the ground at 1,400. So with gold trading, 22, 23, 2,400, I mean, those are major profit margins that they haven't seen in a long time. So I'm with you. I believe that is a great entry point. We encourage you listeners, do your due diligence. Again, if you haven't reviewed our inaugural episode on gold and silver and looked at the show links and, done your own due diligence to figure out, is this the right time for you to enter the space? If you own gold or silver or bullion, then the question is, how do you accelerate the gains that you already have? And one way to do that traditionally is to stack in some miners, some equities that also benefit from the trade. Okay, so today we are going to do a quick 360 on your money. Now, moving forward, we will have shows dedicated to a 360-degree view of all asset classes, where we'll touch on each asset class to simply tell you, is it hot or is it not? Mm-hmm. And so as we look at the whole space out there, I'm going to give you the hot list. So get your pens and pencils ready. Bonds have been hot. There's no doubt. They keep climbing. If you don't know how to trade bonds, we're going to dive in one episode and explain that through either the futures market. There's ETFs out there that you can own bonds and be long bonds, not just collect the interest rate on the bonds, but also crypto. You've seen a recovery in Bitcoin. You've seen a recovery in Ether. Incredible that Bitcoin was at about 60,000, dropped all the way back down to 15,000, then roared all the way back up to 70,000. And now it's trying to figure out where to go. And we'll be discussing its relationship with the NASDAQ. But it's hot. Crypto is hot. Residential real estate, hot, 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 continues with little inventory on the market, overbids on properties that are priced right, and the precious metals, which we've covered at length in our last episode. Tech has been hot and continues to be hot because of the AI boom. Now, the Magnificent Seven, which are tech stocks that make up the majority of the valuation of the S&P 500, the NASDAQ, have really been ruling the market. But when we look at what's not hot, well, believe it or not, most stocks over the last year or two are not hot. Many have taken a massive haircut ever since the boom that we saw post COVID in 21 and 22, and they fell. They fell 60, 70, 80, 90%. So the vast majority have not done well in your portfolio. If you're invested in the indexes, you're doing okay because the Magnificent Seven have really taken up the large portion of that index. Foreign currency, not hot. Argentinian peso getting crushed, pretty much collapsed 75%. The dollar has been very strong and stable. And with the reemergence of inflation, that continues to hold the dollar at a high level, which puts pressure on foreign currency. We're going to be discussing the Japanese yen coming up here. I see some great opportunities in the yen and other foreign currencies. Commercial real estate, not hot. We're going to talk about that today. Not hot at all. With rising interest rates, that results in rising cap rates. Rising cap rates results in lower valuations to commercial real estate. Insurance, not hot, not hot at all. And there's two things to look at in insurance. Insurance affects returns on things like commercial real estate because it's a major cost on the bottom line. But there's also the investment side of insurance, like whole life insurance. And there's ways to build insurance into your portfolio beyond just term life insurance. We'll dive into that in another episode. Today, we're really focused on commercial real estate because we believe that's the most relevant topic, the greatest opportunity. We will throw in some commentary on how insurance is affecting commercial real estate. So that's the what's hot and what's not list. We do have a warming up, and that's commodities. We've been talking about precious metals, but we're going to dive in future episodes here to the whole commodity complex. It looks like commodities, which was on the not hot list for many years, is warming up and could potentially be on the hot list for this next market cycle. So without further ado, let's dive in. Gary Giffin, Jason Riehl joining me. We're going to talk commercial real estate. Gary, I want to turn it over to you because you've done some great research on insurance and how this is affecting residential and commercial. And then we'll come back and discuss the great opportunities in commercial real estate and where we should be putting our money today. So give us the update. What's going on in insurance?
Well, as most people know, and some people don't, because I know when I open an escrow, the first thing I tell my clients, commercial, residential, is you need to get going on getting your insurance policy, or you won't close escrow. And a lot of times they'll wait until about the third week, and then they'll start to scramble because it's not easy, especially if you're in states, California, Florida. Those are the two biggies right now where State Farm, I have on my screen right now, a big announcement. A lot of people have heard of this, but State Farm to exit homeowners renewal policies in California and Florida and several other states. In California, they are sending out non-renewal notices to 72,000 homeowners and apartment policy holders starting this July. So a lot of people, if they're not following that, they'll get a little notice in the mail, and guess what? We're not renewing your policy. Okay, so what do you do? Well, you've got a lot of choices, but California Fair Plan might be their only choice because some of these companies are so small you've never even heard of them. Andrew and Jason, I don't know if you ever heard of Bamboo. That was one of the first companies that one of my clients jumped on Bamboo, and I didn't even know what a bamboo was. And that's I'm seeing that more and more. Bamboo, of course, people have heard of Mercury, Chubb, But the most prevalent one right now for California is California Fair Plan, and that one um, that one's just kind of a subsidy, and we're not sure how they're going to pay out if they ever do, if there's enough money in there to actually pay out if we had a big fire or an earthquake or something like that. So I always tell my clients, hey, number one, get your insurance policy, and number two, while we're in escrow, don't buy a Porsche. Don't buy anything yeah, bigger than a bread box. And I've had clients, and the reason why I say Porsche is I did have a client that bought a Porsche, didn't tell me, and my lender called and said, "Hey Gary, did you know John just bought a Porsche?" I said, "No." Okay, well, I guess we're done then, right? He goes, "Yeah, we're through. Go ahead and call escrow and tell them that we cannot complete the deal because he just spent 100,000 on a Porsche." So things like that happen in escrow, and you just have to be really careful. And so anyway, the insurance is a hot topic right now, and just you'll see more and more on the news as we go along.
Yeah, and you bring up great points. For context for the listeners, both Gary and Jason, their day jobs in the real estate field. They have great experience in both residential, commercial, Jason specifically specializing in property management as well. And so this is affecting people's bottom line at the end of the day. I mean, we discussed homeowners briefly there, but I want to bring the commercial aspect in. And Jason, I'm going to hear your comments next on, all the landlords, the owners that you work with, insuring their properties, watching the cost go up, which affects the bottom line. The California Fair Plan, I've had so much insurance in my business career, whether it's E&O, D&O, moving insurance. We had a moving division with our real estate firm at one point. We've got, whole life. I mean, every type of insurance you can imagine. And the California Fair Plan is when you cannot get insured with anything else. I'm sure Florida has something similar as well in these other states. Well, then the state mandated fund, if you will, steps in. It's incredibly expensive. It's many times 2 to 3 times what your normal coverage would be. And the exclusions in those policies and the deductibles in those policies are horrible at the end of the day. And I know the state's just doing the best they can given the situation and the funding that they have in their budget. But this is becoming one of the largest single line items in commercial real estate expense. And that is a big deal because that again affects valuation of commercial real estate, which we're going to dive into next. So, Jason, on the landlord side, the property management side, what are you seeing as far as insurance coverage and that bottom line, that net that flows into their pocket in cash flow?
Well, it's interesting. Just first as an example, we had a property that we manage here in Solana Beach, commercial property. In the last month, we've had the owner's had two different insurance. He has insurance for different, and the general and different stuff for his property. But he's had two insurance companies come and walk the building. He said that hasn't happened in over 10 years. So just the presence of the insurance company in your building is something new. And I probably did a 2 hour walk from top to bottom, from the roof to the electrical rooms for them to check anything out. And the owners were just kind of flabbergasted just because it never happened before. So obviously, that's a change as far as that's concerned. And then pricing, yeah, it's just a matter of um, liabilities going up. I haven't gotten the update yet from the walks that we had, if there's any change and this is two of the bigger buildings that we manage. So it'll be interesting to see what that net change is. But the fact that they're just showing up the building is just something new, which is interesting. They're looking for stuff or just trying to cover their bases, I assume, as far as that's concerned. And along the same lines, we had an association I'm part of. We had a broker come in talking to a commercial broker specifically in the Poway area. And he's just said, you can't even get insurance for commercial buildings out there. So you have escrows that are just sitting, not closing because you can't get insurance for properties all throughout the Poway area, which is something else. So I think we're in the middle of the storm. What's going to happen? I don't know, but definitely prices are going up. And it's just getting, companies are falling away. As far as commercial is concerned, even my own business as a property manager, we've had, I think, three different insurance companies in the last 3 years as they just leave the commercial coverage business, regardless of what it is, what type of entity you are. They're just no longer covering it. So things are changing and prices are going up as there's less choices.
In one neighborhood in Poway, I've seen now they're sending drones over the neighborhoods and they're checking people's roof. And one of my clients, his mother got a notice that said, "Hey, we're dropping your policy. Your roof needs to be repaired." And so they're sending drones around now, and that's so we'll probably see that in commercial on the commercial side. The only reason I'm mentioning that is they may not have the manpower to go to each commercial building, but they'll send a drone up in the air and check an area, and then you'll come back and see it as a notice. So be wary of that.
Yeah, indeed. Indeed.
Drones are
There's
coming.
one guy can do a lot of work over an entire city, probably in an afternoon. You know what I mean? So
Right.
they're trying to figure out why they lost all the money over the last 10 years. It's a lot of mother nature, but everybody's in a tough spot.
So, how this affects the commercial real estate values, as we discussed, is the line items. I'm with you, Jay. I think that people are going to start self insuring if they're in that position because it doesn't make sense to be spending tens of thousands of dollars on an insurance policy with a deductible of tens or thousands of dollars when you could just park that money in the bank, save it, and then, yes, if something happens, you have a fund. You have your own fund at the end of the day. We're getting to that kind of pricing where self insurance makes sense. The challenge is many investors are not in a position to self insure. And so those escrows that are sitting and not closing, and lenders won't lend without insurance. So there's the other problematic situation. So that brings us to the cash is king. Those who can step in with cash can snap up these transactions in the commercial real estate space, can self insure because there's no loan and they have capital on the sidelines, are going to position themselves for a great recovery in the near future. Now let's move on to the commercial real estate itself. So for context, commercial real estate had probably the largest boom, multi-decade boom since the early 90s after the S&L crisis. We saw cap rates go up. We saw the regional banks fail, and asset classes like multifamily really got annihilated during the early 90s. And there was depreciation and vacancy and golden opportunities for people to buy up some commercial real estate in that recession that lasted pretty much till 1995, even some deals going into 1998. And then it just went on a bull market tear for the last 25, 30 years. And that's because the interest rate cycle was trending down, down, down. And as, again, interest rates trend down, cap rates follow. As cap rates fall, values go up. So when you think about commercial real estate, the best way to think about it is like a bond, right? When bond yields go up, value of the bond goes down. When conversely, the other thing happens, right? You got the yields coming down, then the bond rate is going to go up. So when you think about a cap rate in commercial real estate, people get a little confused with cap rates. I like to break it down as simple as this: is an interest rate. You put your money in the bank. Today, I get, say, 5% on my money. Don't have to do anything. No tenants, toilets, or headaches, right? And if I buy a building and I only get 4%, why would I do that if I can get 5% in the bank? I want to get more than what I would get risk-free in the bank. So
Right.
typically, cap rates are going to be above the risk-free interest rate. And so for that reason, as the Fed moves up their risk-free interest rate, that short-term overnight lending to the bank, the cap rates will follow. So today we find ourselves in a place where you had this 25 to 30 year bull market run where cap rates hit a low of nearly 3%, which is incredible because you weren't getting anything in the bank. You get maybe 1% at its low. And well, you want to get the depreciation in commercial real estate, some of the other advantages like rent increases and appreciation, amortization. So you buy some commercial real estate and there was positive leverage going on. Well, all that has reversed in the last few years. Now what's happening is, again, I can park my money getting 5% in the bank. Why in the world would I want to buy a building for any less than that? I wouldn't. Yet it's like the stages of grieving with the owners that are out there, right? There's denial, right? And then there's the other four stages as you go along, as you grieve loss. And right now we're in the denial phase. We have a lot of inventory hitting the market in the commercial real estate space. This is nationwide. This is not specific to a certain state, where people are still going for that 4.5 cap rate, and they're not selling. Rightfully so, because investors are smart. Why would they want to deal with that headache when they can park their money and get more in the bank risk free? So, with that said, the question is how long will this window last? It is a window. It could be like the 90s and give us several years, and we may not be at the bottom. We may see cap rates climb to 6, 7, 8%, depending on what the Fed does. If that happens, these buildings will depreciate significantly. We've already seen in office up to a 50% haircut. Now, office is a different animal because of the work at home trend. There has been vacancies, and we're seeing, my hometown, San Diego, California, buildings that were selling for $50 million in 2019, even before the pandemic, entering escrow at $20 million. A massive haircut and a massive opportunity for investors to have the staying power. Multifamily, we're only seeing about a 10% discount. Retail, the same. Industrial, very little discount. But the question is at what point will we start to see those same discounts, and what will be the triggers? So, Gary, want to get your thoughts. Jason, want to get your thoughts. What are you seeing on the pricing out there and the investor sentiment as far as diving into what appears to be, for many, a risky market because of vacancy, but in my opinion, an opportunistic market?
First, I was just since we're on the subject, there's an article in CoStar. I think a lot of this, we're talking about the commercial opportunities and maybe places where there are opportunities, has to deal with location. Obviously, real estate's definitely location based, but this is interesting. I'm just going to read a couple sentences here. In the latest sign of how lower demand is hitting part of the U.S. office market, this is office. One of the tallest towers in St. Louis that sold for $205 million in 2006 has changed hands again this week for $3.6 million. So it's literally dropped. 18 years ago, it was about $140 a square foot. Now it's trading at $2.50 a square foot. So, I mean, I don't know how hot the St. Louis office market is. Obviously, it's not that hot, but that's just an extreme example of how, rates have an effect on stuff, and also changing, lifestyles and et cetera, et cetera. But that was just something to get out there. It's a CoStar article, came out April 10th, if anyone's interested in checking it out.
And it's incredible the fact that something that sold for $205 million is now trading for what, $3.5 million, because the replacement cost on that building to build a building like that
Oh yeah.
has got to be 50 or $100 million at least, if not more. But to your point, there's a demographic shift, there's a trend in lifestyle. And if the vacancy's 60, 70%, the operating costs on these big buildings is what the killer is.
Hmm.
Because yes, you can buy it for 3.5 million, but if it's costing you 500,000 or 1 million to operate every single year, and you don't have enough cash flow coming in to cover those expenses, and this trend continues, or the building needs vast improvements, some capital expenditures of 40, 50 million, you're really signing up for that. So there is some incredible opportunities that people will look back if the trend reverses and people are called back to the office.
Right.
We're going to see a lot of empty shopping centers too. I'm noticing and this was on the news, the 99-cent store is now closing all their stores. I'm even seeing some Walmarts that are coming out of big shopping centers. So that's going to, once that's pulled out, what are you going to have? You're going to have a big hole with just a lot of little retailers trying to make it, and somebody's going to have to make up that difference, or it's just going to be a ghost town. And I'm seeing now, even in units, I'm seeing emails come out to me that normally would be like a pocket listing, but they're emailing it out to everybody because they want everybody to see, hey, I've got these whatever 10 units, 15 units. We just refurbish them. We're looking for a buyer. Normally, that would be handled through each broker, but now I'm seeing it on email. I'm seeing it on not only CoStar but LoopNet. You're seeing buildings just sit there and just accumulate time. And so I think we're going to see more and more of that in every state.
There's incredible opportunity at this point. I personally have been waiting for this for my whole career. We form syndications, real estate syndications allow people to invest and pick up, some of these market opportunities. And one of the beautiful things that you can do if you have a self-directed IRA or 401k is you can invest through that IRA or 401k. And if you're in a position to buy cash, and you can pool with other investors and buy in cash and you have the staying power. That's the key thing here. And you're not dependent on that significant cash flow right now. Buckle up and hold on and just let the market recover. There is a timing standpoint, but the larger haircut has already happened. We've already seen, unless we have pandemic part two, God forbid, we've already seen the massive shift in lifestyle and office, for example. The work from home party very well may be ending soon. For those who have the um, capacity and ability to work at home because of either they're their own boss, they call the shots, they're a thought consultant, somebody that doesn't need to be physically present and their company allows that, that's fine. But that's the exception, not the rule. For the most part, people have had the luxury of being at home because of the pandemic and post-pandemic. Now we're years and years past the pandemic. People got used to it. They enjoy it. But all it'll take is one deep recession, in my professional opinion, for employers to say, get back to the office. You want money, you want your salary, you come back to the office. And when that happens, when that trend swings, you have to already own the real estate. It will be too late if you're trying to snap up the office buildings at that point in time. Now, for multifamily, I want to get your 2 cents. What's going to be the trigger to generate this level of vacancy and depreciation? Because there was a huge movement in 2017 through 2021 of syndicators buying up multifamily all over the nation. Many of them did end up buying the peak 2020, 21, 22. And now at the highest level, on the institutional level, we are seeing a haircut. I spotted one up in Silicon Valley, the San Jose area. An institution paid 110 million in 22. They just spun it around and resold it. This is A-class new build for 90 million. So they took a $20 million haircut, about a 20% haircut. But the question is on the B and C class, the workforce, they're still 80, 90% occupied nationwide. In tight markets like California, they're 98% occupied. Rents are still rising. But Jay, I want to talk to you about rent control and what would trigger that level of some vacancy, some depreciation besides the cap rate. Are you seeing any friction with it taking longer to get things rented?
I can see that coming on the horizon. What I do see now is just more supply coming to market as far as rentals in general are concerned. I know San Diego, over the last 10 years, even just in the city of San Diego, there was over 20,000 units approved to be built, and they're all rentals. That's like in downtown and around the downtown area. So that stuff is still coming to market. So I think we're having the first thing that needs to happen is more supply coming to market. And then as more supply comes to market, the demand is still strong in San Diego, but last year was, in my experience, the most difficult and contentious and most negotiated lease renewals I've had since I've been doing this the last decade, just because of the increase in prices we've had for the last 3 or 4 years. 7% on top of 10% on top of 5%. So that starts to add up and it's really squeezing people's pocketbooks pretty darn tight. So the supply coming into the market, I think is a leading indicator as far as the market's definitely leveling out as far as rentals are concerned and pricing. Owners still want the moon, but it seems like people that are shopping around, tenants that are shopping around, they can see that it's softening up a little bit. They have more options out there. As far as the law side of it, California, we're always getting peppered with new laws every quarter. It seems like trying to hinder an owner's ability to control their property based on, you know, what they make up in Sacramento. So that's part of the part of the territory. Most people are dealing with it okay. That just keeps people in properties a little bit longer, it seems like. And another aspect too, just as far as we've had people that are, you know, leaving the area and just want to rent out their properties because they can't sell it for what they bought it for 3 years ago. So there's another, so you know, that's going to have multiple effects down the line if they can't get what they want for the rent and they don't want to hold on to it. So, you know, there's a lot of cross currents going on as far as that's concerned. Um, the only other thing is if we actually do have a slowdown in the economy, usually rent doesn't take that big of a hit. I think in the 2006, 7, and 8 crisis, it was down about 10% across the board. So rent usually does not take a hit. I've seen the higher end properties drop 15% year over year as far as what rent they're getting, depending on the location and the time. It's just been a really funky market. So um, there's more opportunity for renters. So that's going to be like just a softening in the market. And it all depends on location too, kind of same with the commercial stuff and your sector. So there are opportunities out there depending on where it's at. Infill opportunities, places that are crowded and things like that in each area in town. So there definitely is some opportunity there with cash.
Or selling is what you're describing. And in any deep market recession, there's the saying that lower prices bring out sellers and higher prices bring out buyers, which is contrary to the way you're really supposed to invest as a contrarian, right? When it's lower
Sure.
prices, you should be buying, and when it's higher prices, you should be selling. But the natural herd mentality is, buy high and sell low, sadly. And we saw a lot of buying high, right, over this last few years. So now it's like the hangover, the after effect of people, as you mentioned, they're, although they may have that low mortgage rate if they're in residential, that's all great. But if it still doesn't pencil for the rental, doesn't matter how low your interest rate is.
Yeah, it's still the
And
cash,
that's right. And on the commercial side, all this stuff recasts every 5, 7, or 10 years.
Yeah,
So now that we're entering, like in multifamily, in the next 2 years, 50% of all the outstanding debt, 50% nationwide, will need to be refinanced. And I'm seeing assumable loans that look really attractive on some of these listings, but the assumption only lasts one more year. So it's great to get in now at 3%, but I got to refinance at 7% on that commercial building next year anyway. So it's a nice little bonus on the marketing material, but it really long term doesn't impact the cash flow. So the reckoning is here. It's coming. It's going to continue as these interest rates, even if they just hold. And I know everybody's waiting for the Fed to move down interest rates, but I've got news. The Fed doesn't necessarily control. I know they try to manipulate the 10 and 30-year, bonds with their buying and selling, but they're controlling that overnight bank rate. So just because an inverted yield curve, which we have today, starts to flatten out or steepen, does not control the overall bond market. And the bond market is speaking right now saying we're going to keep these rates higher and start to compete with stocks. So as long as that 10-year, which is mainly what people refinance into in their commercial real estate, and in residential, it's the 30-year. As long as those stay stable, we're going to continue to see this reckoning in the real estate market.
right.
Gary, any closing thoughts as we wrap up on the commercial real estate space and what you're seeing?
My closing thoughts is I'm always in front of the computer looking for the next great deal. And it's, I think you're right, Andrew. It's just a matter of weeks, months until we really see the market play. And I think we're going to see a lot of listings that will show up in these places that they hadn't been marketing before. They're just, I think we're going to see a flood of those. And for people like ourselves that are on this, put together syndications to be ready for it and buy that, that dream property with the right situation and make the investors some really good money. So that's pretty exciting.
Yeah, there's more fireworks to come. I think you hit it on the head with the rates, and the fact that the short-term rates at the commercial properties in need to be recasted. And if they got them at 3 and they're at 6 now, that's a lot of money to come up with. So hunker down and have cash ready to deploy in the next couple of years, what you've been saying. It seems like it could happen. So
The debt service coverage ratio is one of the key metrics that investors are familiar with if you're in the commercial real estate space. But if you're considering breaking in, DSCR, you can look it up online. But essentially, what it means is the lenders, when they fund on these commercial properties, they're not looking at the credit worthiness of the individual. They're looking at the asset itself. They're underwriting it. I was speaking with JP Morgan recently, and one of their head underwriters said to me, we basically underwrite as if we have to foreclose from the very beginning right now, because that's how risky the market is. And with that, they're looking at this debt to service coverage ratio, meaning, do you have enough reserves in the bank to cover at least 9 to 12 months of the debt service, right? The interest payments. And what is the ratio compared to what income is being brought into the property? Now, they want to see 1.25,
right.
meaning if it's cash flowing, say $1 million, right? And you've got debt that is 750,000. Well, that's enough to cover it. But if that debt all of a sudden starts to be $1 million and the income's only $1 million, that's a debt to service coverage ratio of 1. That's underneath that 1.25. They have the right to call these loans due. That's a big deal,
Right.
because if they get themselves in a pinch and they need to raise capital and they actually start exercising these acceleration clauses, that would be the forced selling that we talked about. The takeaway I would give every listener out there, whether you're a small operator, an individual investor, running a pension fund or an institution, is now is the time to prepare and act swiftly. These windows only present themselves every few decades. And when they do, sometimes they're gone in 18 months. We sometimes have some extended windows that last 72 months, but the window comes and goes. And so if you want to gather friends and family and start to prepare, do those soft capital calls to figure out what you could go buy in your local community, do your research. You've got CoStar for professionals. Doesn't mean you have to be a licensee to join CoStar, but that will cost you several $100s a month for a subscription. That's where the professionals seek out their commercial real estate. We'll put some links here in the show notes. LoopNet is more like the advertising engine. It's owned by CoStar. It's fine to browse LoopNet, and there's some other competitors out there, some newer websites like Crexy and otherwise. But at the end of the day, all the inventory, the true inventory, resides on CoStar. Only about half that inventory shows up on LoopNet. So if you're online hunting, just know you're missing half the inventory by not being a subscriber at CoStar. And of course, locating that commercial professional that has the inside track that can present opportunities that are not on the market. Seek out those individuals, and certainly you could reach out and we can put you in touch with people if you don't have that professional by your side. But the takeaway is preparation at the end of the day, and get ready for execution. It takes a steel stomach, like Jason mentioned in our last episode, to step into markets at this point in time. But those who are buying when others are fearful are usually rewarded in the cycle to come. So thank you for joining us today. Tune in to our next episode as we dive deeper on the financial markets and cover your money 360.